A very good morning to all the participants of this webinar from DTRTI Lucknow. I am Arvind Mishra, Deputy Director, welcoming you to this webinar session on Basic Accounting Procedures, Journal Entry Part 2. So as you might be able to watch my screen, I want to make some points, or I want to repeat certain points that were made in yesterday's lecture so that a little bit of revision happens. Now, yesterday we saw that the accounting equation becomes true in all cases. Now, what is this accounting equation? You see, we have the balance sheet, and in the balance sheet, we have capital introduction or capital account on the left hand side, and we have liabilities on the left hand side, and we have assets on the right hand side. And both the left and right side of the balance sheet are balanced, if you might have seen that. So the accounting equation in essence is that capital plus liabilities is equal to the assets, which are on the right hand side. Capital and liabilities are placed on the left hand side. The total of the capital and liabilities which is kept on the left hand side of the balance sheet is equal to the total value of the assets, which is kept on the right hand side. Now let us say a person starts his business with 10 lakh rupees capital and cash. Now, whenever he will enter into a transaction, his cash balance will alter in two ways. Either the cash balance will increase or the cash balance will decrease. Supposing he makes the payment for goods which he has purchased, his cash balance is likely to, or would rather, decrease because he has made payment. If he makes payment for salary, his cash balance will decrease. If he makes payment for rent, his cash balance would decrease. Whereas when he sells some goods and gets cash for it, his cash balance would increase. Or when his customers will make payment to whom he had made credit sales earlier, when the customers will make the payment, his cash balance will increase. So whenever he enters into any transaction, his cash balance would either increase or it will decrease. Now, one way of writing it is that whenever a transaction is written, we also write the cash balance which is remaining at that point of time. But if we go on writing cash balance every now and then, our task would become more burdensome and we would be involving complexity in writing of the transaction right from the beginning. So it is necessary that right from the beginning we avoid certain things which will lead to a lot of writing effort for us in future. So instead of that, it would be better that instead of writing the cash balance every time a transaction happens, we'll just write all the transactions that lead to increase of the cash balance on one side or in one column, and all those transactions which would lead to reducing the cash balance, we will write in a different column. So we'll have two columns. One will get those transactions which lead to increase in the cash balance, and the other column will get those transactions which lead to reduction in the cash balance. And later on, once we have entered all the transactions, we'll just total up both the columns and take the net result of them by subtracting. We'll just add all the increases we'll add all the increases in the cash balance to the opening cash balance, and then we will reduce or deduct the total of the decreases in the cash balances so that then we will know what is the cash closing balance at the end of the account. Now, in this manner, we will have our important information relating to cash. Now, this can be shown like this, that if we have an imaginary cash account, we have an opening balance, and then we are making entries where the cash balance is increasing, like 2,50,000, 2 lakh, 5 lakh, 1,35,000, 4 lakh. So the cash balances are increasing on the left hand side of this column, and whereas on the right hand side the cash balance is decreasing. So we call this kind of account a T form. It looks like a T with a horizontal line on the top and the vertical line in the middle. The vertical line in the middle divides the left and right side of the account. And so in this manner, we are not having to write the balance after every transaction. We are avoiding to write the balance after every small transaction. You might have also noticed that every transaction is numbered here. So why every transaction is numbered? Because we can assume that it is coming here from some other place where it was initially entered, which can also mean a journal. A journal entry was made somewhere, and then from there the entry is transferred to this account, just as it happens in the ledger accounts. So what we are saying is that this is a nice way of recording transactions, where we have an opening balance and then we have the increases, and then on the other side we have the decreases, and finally we have the closing balance. And both the sides are neatly balanced, 2485, 2485. Now, here every account, here this account is showing only the amount, and it is not showing the description of the transactions. Why it is not doing that? Because it is written in a concise way. If we want, we can introduce columns here, and in those columns we can write the description also of every transaction, and we can also write the date of the transaction, and every transaction we can put in a separate row. So that would make things more comprehensible to us. Or what we can do is that we can put all the numbered transactions in a journal, and from there we transfer them over here. Or we can do both the things. We write the journal entry, and when we write the account here, in the account also we write the description as well as the date, as well as this number, which is called the ledger folio number, or the journal folio number, showing that from which folio of the journal this is coming here. So this is the one example of having a cash account maintained with us. So let us take some more examples. Let's say that there is an introduction of cash into the business. Transaction number 1. We are just taking some more examples. There is an introduction of cash of, let's say, 25 lakh rupees by the owner. Owner is introducing capital in form of cash. Now, when he introduces capital in form of cash, two accounts are going to be affected in his books of accounts. One is the cash account and other is the capital account. The primary transaction is introduction of cash, which means that in his cash book he will enter 25 lakh cash, As you can see here, when the increase is there, we are putting it on the left side, and in case of cash, and when there is a decrease of cash, we put it on the right side. On the other hand, while maintaining the capital account, we put the decrease on the left hand side and we put the increase on the right hand side. Similarly for liabilities also. If it was a liability, the decrease would be written on the left hand side and increase of the liability would be written on the right hand side. By doing that, the accounting equation remains balanced. Now, this question is asked, why we put the decrease in the capital account on the left hand side, and why do we put it on the right hand side in the cash account? Because cash account is an asset account. We know that liabilities plus capital should be equal to assets. So therefore, whatever we do with liabilities or whatever we do with capital, we have to do the opposite with the assets. So here we have put the capital increase on the right hand side and we have put the cash increase on the left hand side. So if you just assume that we are writing a balance sheet of sorts here, there is one entry of increase on the left hand side and there is another entry of increase on the right hand side, and both the entries are now balanced. Because the balance sheet needs to be balanced all the time, because balance sheet is balanced by the balancing equation or the accounting equation. The balance sheet is balanced due to the working of the accounting equation on every line of it or every row of it. Now let's say we take one more example here. Supposing we had some creditors and to whom we had to pay them cash because earlier we had probably purchased something from them, or maybe we have taken a loan earlier which we are repaying. So let us say that we are paying to the creditor 14 lakh rupees. When we pay 14 lakh to creditor, again two accounts will be affected here. You see, whenever two accounts are affected, we try to find out which are those two accounts which are being affected. Those two accounts will be from one of the three categories. Either there will be a capital account or a liability account, or it will be a asset account. Of course, the income and expenditure account are also part of we can take them to be part of the capital account, because every piece of income is added to the capital and every piece of expenditure reduces from the capital. Because the business ultimately is generating profit or in capital of and every year's net profit is added to the therefore owner's capital. Now when we pay cash to the creditor, two accounts are affected. One is the cash account, because cash goes into that account, cash goes out of that account, and there is therefore a decrease of cash. And since it is a decrease, we put it on the right side here. As you can see, 14 lakh on the right side, decrease. Because cash account is an asset account, and therefore decreases will be put on the right side. And the second account which will be affected will be the creditor will decrease, because earlier we had more creditors and now we have repaid the creditor. So amount of the creditor would decrease. Therefore, as you can see, the decrease of the creditor we are putting on the left hand side. So here again, if you see it like an accounting equation or a balance sheet, you can see that cash is decreased on the right hand side and creditor is decreased on the left hand side. So there is an equal right and the left side, and accounting equation is thereby again balanced, and the balance sheet remains balanced by the accounting equation. So in essence, whatever transaction we are entering here, it is leading to double effect. Double effect means either it is affecting one of the it is affecting two of the three broad categories of the accounts out of capital, liability, and assets. There are three categories of accounts: capital accounts, liability accounts, and asset accounts. Out of these three categories, two categories are affected by every transaction. And they are affected in such a manner that the accounting equation remains balanced, as we have seen in one or two examples here. So finally, having understood some basics about how this accounting equation is happening, and why the accounting equation, because ultimately the accounting equation is the essence of bookkeeping. And when you are reading physics and other things, you are having so many equations to master, or mathematics. Out here, there is just one equation that is to be mastered. That's all. Nothing else. So who would say that accounting is very, very tough? Nobody. We make it look as if it is tough. You can make anything look very tough by including jargon and technicalities and things like that. But if you talk in a simple way, then you understand that most of the things which look complex at first look are not at all complex. So finally, we come to the conclusion that account can be written by dividing any account into two sides, left side and the right side. And on the left side, we should have the four columns like date, particular, reference of the journal, folio, and amount. And on the right side also the same column should be there, the date, particular, reference of the journal, folio, and amount. So any account should have these two sides containing these four columns. So now we have to understand the language of debit and credit. So far we are talking about increase and decrease. Instead of increase or decrease on the left side or the right side, we just use the words debit and credit. So wherever we are talking about an increase and decrease entries on the left and the right side, we should think in terms of renaming them as debit and credit. And how do we rename them? The increase entry, when it is put on the left side, we say whenever any entry is put on the left side of any account, we say that we are debiting that account. And whenever we put any entry on the right side of any account, we say that we are crediting that account. That's all. That's all there is to it. So formally, this is the formal way of referring to increase and decrease. To increase and decrease on the left side or the right side. When we say debit side, what we are meaning to say is we are talking about the left side. And when we say credit side, what we are meaning to say, we are talking about the right side. So debit is left and credit is right. That's all there is to it. And we have already seen that if it is a capital account or a liability account, in that case, whenever there is an increase of the liability, okay, we put it in the right side, and whenever there is an asset account and there is an increase of the asset, we put it on the left side and we say that we have debited an asset account. This is the very basis of debit and credit. So we know that when we reduce the total of the liabilities from the total of the assets, what we get is the capital. So here we have this accounting equation, assets equal to liabilities plus capital. One more thing we have to remember is that whenever there is an income, or rather we can say that whenever there is an increase in the revenue, we enter it as if we are entering it in the capital account, though we keep it separate initially in form of the profit and loss account and the trading account. All the incomes and expenditures we are normally writing in the trading account and the profit and loss account. We could have written it straight in the capital account itself, but just for convenience sake, we are writing it separately. So whenever there is a introduction of capital, let's say, or when the capital increases, the capital account may increase by introduction of capital. The capital account may also increase by income. So whenever there is an increase in the capital, we are writing it on the right side, and whenever there is a decrease in the capital, we are writing on the left side. The decrease in the capital may happen by withdrawing the capital, and it can also happen by making an expenditure. So having understood this, just to explain a few transactions as to how the accounting equation is being balanced by those transactions. Now let us say that somebody starts his business with a cash introduction in the capital account of rupees 10 lakh. So when he introduces cash of 10 lakh, his cash account will increase and his capital account will also increase. So cash account being part of the assets, his assets will increase by 10 lakh and his capital would also increase by 10 lakh. Nothing will happen to the liability, because as I said, every transaction will lead to a change in 2 out of the 3 categories, out of assets, liabilities and capital. So in this first example, where cash is being introduced in the capital account, what is happening here is that the assets are being affected and capital is being affected. Now, supposing somebody borrows for the business, again here the cash will go up because cash will come in form of the borrowing, and liability would also go up, but nothing will happen to the capital here. When he withdraws cash from the business of 2 lakh rupees, his assets will go down because his cash will reduce. At the same time, his capital will also reduce, but nothing will happen to the liability. When he repays the loan to the extent of 1 lakh rupees, his cash will reduce by 1 lakh rupees and his liability would also reduce by 1 lakh rupees. Nothing will happen to the capital. So with every transaction, 2 of the 3 categories will be affected, and they will be affected in such a manner that the accounting equation will remain balanced. So how the accounting equation will remain balanced? Either there will be a reduction on both sides of the accounting equation, or there will be an increase on both sides of the accounting equation. It is not that one side of the accounting equation will increase and the other side will decrease. That cannot happen, because then the balance would be disturbed. So either, as you can see in these 4 examples, either there would be increase on both the sides of the accounting equation, or there would be a decrease on both sides of the accounting equation, and the decrease and increase both will be of the same magnitude. Now, here as you can see, the assets, in case of increase of asset we are writing a plus, and in case of decrease of asset we are writing minus. Instead of writing plus and minus, what we do is that we just divide the asset account in two sides. On one side we write the increase and the other side we write the decrease. Similarly, for liabilities, we divide the liability account also in two parts. We write the decrease on one side and increase on the other side. Similarly, for owner's capital also, we put the decreases on one side and increases on the other side. So it has been a tradition. If you will ask me, why do you put the decrease on this side and increase on that side, I would just say that it is a tradition. The tradition could be the very opposite also, could have been, but it is not like that. So whenever there are assets account, all the increases are recorded on the left side of it, and all the decreases of the asset account in the asset account are recorded on the right hand side of it. Whereas in the case of a liabilities account or a capital account, all the increases are recorded on the right hand side and all the decreases are recorded on the left hand side. And in fact, all the accounts are divided into these three categories. Either they are the capital, they are part of capital account, or they are part of the liability account, or they are part of the assets account. So it's like this. Now, let's say that this tradition of when we are recording the assets and increase and decrease in this manner, or when we are recording liabilities and capital in this manner, this leads to 5 rules ultimately. And we can summarize those 5 rules. That increase in assets are debits. Debits means written on the left side. Decrease in assets are credits because they are written on the right side. Increase in liabilities are credits. Whenever we say credit, you can read it as right side. Whenever we say debits, you can read it as left side. All the increase in the liabilities are written on the right side. All the decreases in the liabilities are written on the left side. All the increases in the owner's capital are written on the right side, and all the decreases in the owner's capital are written on the left side. Debits means left side, credit means right side. Whenever expenses increase, they are written on the left side, and whenever credits decrease, or so rather when expenses decrease, they are written on the right side of the expense account. On the other hand, whenever revenue increases or incomes increase, they are written on the right side of the income or the revenue account, and whenever the income or revenue decreases, it is written on the left side of that account. So the term debit means left side and the term credit means right side, and they should not be taken to mean either favorable or unfavorable at all. We should not think debit as something unfavorable, or we should not think credit as something favorable. We should rather think of debit and credit as left and right, that's all. So now, having understood these the basic rules that are coming out of the tradition of writing the accounts, and after having understood the accounting equation, we will go on to the next part of it. It's called transactions. Now, a transaction is also a type of event. A transaction is a type of event which is external in nature and can be determined in terms of money, because all the events which can be written in terms of money, they can only be recorded in the books of accounts. So in any accounting period, every business will have a huge number of transactions, and they all will be determined in the financial terms or the money terms, and then they will be recorded individually after measurement and valuation. So transaction, as we have seen is a two-way process. Transaction, the word transaction means two-way process. I give you something, you give me something else in return. लेन देन जिसको बोलते हैं. Transaction is a two-way process, लेना देना, in which value is transferred from one party to the other party, and from that party to this party. So in any transaction, either one party receives a value in terms of goods, etc., and passes the value in terms of money, or the opposite happens where value is received in terms of money and value is passed in terms of goods. Therefore, in any transaction, a party receives as well as gives away some value in some form or the other. Now, when we come to recording of the transaction in the books of accounts, it is important that we record only those transactions where they are supported by substantial document, like purchase invoice or bill, or the pay slip, or the cash memo, or the passbook. Some substantial document should be there, not necessarily physical document. It could be electronic document, anything. But some substantial document should be there, on the basis of which we will use to record the transaction in the books. So first thing that we do is that we convert the transaction in terms of money, and while we are supported by proper documents, we record that transaction in the books of accounts under the double entry system. So in the double entry system, as we have seen, the two accounts are affected by every transaction. To analyze the dual aspect of every transaction, we use two approaches. One is the accounting equation approach, other is the traditional approach. So first of all, let us again try to understand the accounting equation approach. So the accounting equation approach talks about a relationship between the assets and liabilities and the owner's capital or owner's equity in the form of an equation which is known as the accounting equation. The basic accounting equation, rather, implies that when we total the capital and the liabilities, it will come equal to the assets. Where assets means whatever the business owns, the capital and liabilities are what the business owes. So the difference between ownership and owing. Why the capital is something which the business owes? Because capital is something which is received from the owner of the business by the business. As we have seen that we see the business as something different from the owner. And therefore we say that business has received capital from the owner, and therefore it has a liability towards the owner to return that capital to him. So capital and liabilities are the owings of or something which the business owes to somebody else. And on the other hand, assets is something which he owns, OWNS. Under the double entry system, every business transaction will have a twofold effect on the business enterprise, where every transaction will effect changes in the asset, liability, or the capital in such a way that an accounting equation is completed and equated, as we have discussed earlier also. And as we have said, that every transaction will affect two out of these three categories: asset, liability, or capital. This accounting equation will hold good at all points of time in every transaction and for any number of transactions and events, except when you make a mistake in the accounting process. So let's suppose that A person starts his business by contributing 50 lakh rupees of his own money, and which is called capital, and he also takes a loan of 10 lakh rupees from a bank, which is repayable after 5 years along with interest. Also, this individual purchases some furniture which is costing 10 lakh rupees, and he buys goods or merchandise which he will be selling worth 50 lakh rupees. Now, for purchasing the merchandise, he did not pay the entire 50 lakh rupees, he paid 40 lakh rupees to the suppliers, and he told the suppliers, or he agreed with the suppliers, that he will pay the balance 10 lakh rupees after 3 months. So let's say that all these transactions and events have occurred at a base point of time. Now, the contribution by the owner is termed as capital, is known as capital. The borrowings that he has made are known as loans or liabilities. And whenever a loan is repayable in short run or in a short period of time, say within a year, it is called a short-term loan or a short-term liability. On the other hand, if the loan will be repayable within, say, 4 to 5 years or more, it will be called a long-term liability or a long period liability. Now, liabilities could be in the nature of trade liabilities also. For example, if he purchases something and has to make the payment for it, so that is also a liability. It's called a short-term liability. The trade payables are called short-term liabilities, which are related to credit purchases of the goods or merchandise. Popular name is trade payable, but it's a short-term liability because it is to be paid against the purchase. So when we make a purchase and we have to make a payment, nobody is going to wait for years to receive his payment. He wants the payment immediately. Let's say 15 days, 20 days at the most. Sometimes maybe 1 month, 2 months, 3 months also. Every supplier wants his money as quickly as possible to rotate it in his business. And for merchandise purchases, we use the word trade payables for the, and for other purchases and services which we receive on credit, we use the word expense payables for the liability. Now, these short-term liabilities are called current liabilities, which are repayable within a year, within 1 year. On the other hand, money which is raised whatever money has been raised by the businessman, he has invested that in 2 types of assets. One is the fixed assets and the other is the current assets. Now, furniture is a fixed asset. If it lasts for a long time, say for more than 1 year, and it's being utilized in the business, whereas inventory and cash balance, stock inventory and cash balance will not remain fixed for a long time, and they are subject to change continuously. So as the business starts to roll these cash balances, and the inventory will continuously keep on changing, and therefore these are called current assets. So often the owner's claim or the fund in the business is called equity or the owner's capital. That is the owner's claim on the business, because the owner has contributed the capital and he wants it back ultimately. So owner's claim will be on the capital as well as on the profit, and after reduction of all the losses. So we can say that accounting equation should be written like this, that equity or capital plus the long-term liabilities will be equal to fixed assets plus the current assets and minus the current liabilities. Normally we reduce the current liabilities from the current assets to make it look more rational. So therefore, we can look at it like this, that in case we want to write the equation for cash, we can say cash is equal to capital plus loan minus furniture minus payment to trade payables. Just applying the accounting equation, that's all. Or rather expanding the accounting equation to include the specific kinds of liabilities and the specific kind of assets into the accounting equation. Now let us suppose that at the end of the period, a businessman has inventory valued at rupees 2,500 in his hand. He has cash 2,000 rupees, which are written here among assets. Two 200 rupees taken as loss of the value due to use of the furniture, because initially he had the furniture of 1,000 rupees and now that furniture has lost in value, and right now today the furniture is valued at 800 rupees. So his long-term liability is 1,000 rupees and he has a short current term liability or a short-term liability of 500 rupees. So in that case, when we reduce the liabilities from assets, we get a capital or equity of 3,800 rupees. We are calculating the equity by reducing the liabilities from the assets. So if we have to look at it carefully, here in this case, now what is happening is that in the equation 2, it is written in 000. That means whatever amounts are written here are in million. Let's say if we write 5,000 million, or 5,000 million means it is 50 lakh rupees. So there was an equity of 50 lakh rupees, and when we finally calculated the equity, it is 38 lakh rupees. So 50 lakh minus 38 lakh, which is 12 lakh, is the reduction in the equity, and reduction in equity is termed as the loss. Reduction in equity is termed as the loss. Earlier the equity was 50 lakh, now the equity is 38 lakhs. 12 lakh is the reduction in the equity. And how the equity reduces? Because in the equity or in the capital, the incomes are also being added and expenses are also being reduced. So in this case, loss has happened. So if there is an increase in equity, we can say that there is a profit. If there is a decrease in equity, we say that there is a loss. So let's say we take an illustration to show this. We have at the end of accounting period and at the beginning of the accounting period, we have certain particulars. These are the particulars which are at the beginning of the accounting period: capital, loan, trade payables, fixed asset, inventory, trade receivables, cash and bank. And at the end of the accounting period, the same balances are given except the capital here. And question is being asked that what is the profit? So, and we are also being asked to prepare a balance sheet at the end of the accounting period. So balance sheet is always prepared at the end of the accounting period. And when we prepare a balance sheet, we put the assets on the right side and we put the capital and the liabilities on the left side. So here, we don't know the end of the year capital. We have to find the end of the year capital. So end of the year capital can be found out if we reduce the liabilities from the assets. So here we are saying that we have a equity of 51,000, or rather 510 lakh. I'll just read it as 51,000. Now let's say that we had a capital of 51,000. We call it E0. So the initial details are called at time t equal to 0, and let's say the end of the year, end of the accounting period details are called at the time period equal to 1, t equal to 1. So here E0 is 51,000. L0 means liability 0. We are adding up all the liabilities at the beginning of the period. So we have a loan of 11,500 and we have trade payables of 5,700. These are the liabilities at the L0. We add them up, we get the liabilities. Then liability we add up to the capital, and therefore that should be equal to the assets. So first of all, we'll just check it out because we have to make a balance sheet at the beginning of the period also and at the end of the period also. So we are finding E0 as 15,000, L0 as loan plus trade payables, and A0 is the asset at time t equal to 0, and we add up the assets by adding up fixed assets to inventory plus trade receivables plus cash at the bank, and we get a figure of 68,200. And finally, we write it in the form of the accounting equation, and we get 51,000 as equity plus, we are coming from here, E0 plus 17,200, which is L0, liability 0, and A0 is the assets at time t equal to 0. So we can see that the accounting equation is balancing. So whenever we are given a set of details or a trial balance, what we call, we should be able to first of all check whether in order to be able to make balance sheet that the accounting equation is working out or not. Similarly, we go to the end of the period, we say L1. So L1 also we add up loan and trade payables, and we calculate A1 by adding all the assets. And finally, we reduce the liabilities at time t equal to 0 or time t equal to 1 from the assets at time t equal to 1. So we reduce liabilities from assets and we get capital. So here, or rather equity. So by reducing, we are getting a figure of 51,420. Now, 51,420 is the equity at the end of the accounting period. At the beginning of the accounting period, we had a equity of 51,000. So basically our equity has increased from 51,000 to 51,420. And so we can say that we have made a profit of rupees 420. You can add the 3 zeros here. And we are writing the balance sheet at the end of the accounting period by writing the capital which we started with, as 51,000, and we add the profit of 420 here, and we get the capital at the end of the accounting period of 51,420. And of course, end of the period loan is already given in the particulars field above, that is 11,500, which we have used here also while calculating L1. And then of course the trade payables, which is 5,800. This is all written on the left side, and because these are liabilities, and assets we are writing on the right hand side, which in fact, as a matter of fact, we have added here also. And the total of that is coming to 68,720. So this is the balance sheet. So in the balance sheet, you should always remember on the left side we are putting the capital, and below the capital we are putting the liabilities of the business. And liability is something which we have borrowed, or we are supposed to pay for the goods that we have taken. So if we get some goods or inventory, it comes on the right hand side, and against that the liability will be incurred on the left hand side of the balance sheet. It will be written on the left side of the balance sheet, and thereby the balance sheet remains balanced due to the working of the accounting equation. Now let's say that we take one more example. Now let's say that we are given some details. What we are saying is that if certain detail is missing, that can be calculated by using the accounting equation. So Mr. Dravid, you can call him Rahul Dravid also if you want, he has provided us the following details related to his financials, and we have been asked to find out the missing figure here. So he says that I have made a profit of 5,000, and I had assets at the beginning of the year which are A, and my liabilities at the beginning of the year were 12,000, and my end of the year were, let's say, B, and my liabilities at the end of the year were C. And finally, I have a closing capital of 35,000, and at the end of the year, my total liabilities, including the capital, which means that the total of the balance sheet at the end of the year is 50,000. And the missing figure, which means the assets at the beginning of the year, have to be found out, and assets at the end of the year have to be found out, and the liabilities at the end of the year have to be found out. Very clear that if we have the total of the liability including capital at the end of the year, it should be equal to the assets at the end of the year, so which is 50,000. So total liability including capital at the end of the year, 50,000, is the same as the assets at the end of the year, because balance sheet has to be balanced. So the figure B is clearly 50,000 here. Now we have to calculate the opening capital, because to calculate the assets at the beginning of the year, we know that in order to be able to calculate the assets at the beginning of the year, we know for sure that the closing capital minus the profits earned during the year should be equal to the opening capital. Closing capital is already given to us as 35,000 rupees, and the profits that were made during the year is 5,000 rupees. So we reduce the profits from the closing capital, and we get the opening capital. So this is the way we get the opening capital. And once we have the opening capital, which is 30,000 rupees, we can get the opening assets if we add the opening capital to the opening liabilities. Opening liabilities are already given here as 12,000 rupees. So we add the opening liabilities to the opening capital, and we get the opening assets. So opening assets means A. We have got A, and we already have the B, So just to calculate the liabilities at the end of the year, we have the total liabilities including capital 50,000 and we have the closing capital 35,000. We just reduce the closing capital from the total of the liabilities including capital and we get the liabilities at the end of the year, which is 15,000. And if you want to have the assets, we have already got the assets as 50,000 because that is equal to the closing capital plus the closing liabilities which are already given. Now this was the accounting equation approach to prepare the balance sheet and to write the accounts. Now we move on to the traditional approach, and for the traditional approach we will cover this up in our session in the evening at 9 p.m. And this is a very, very important traditional approach because lots of questions are asked relating to this traditional approach, because we also have the categorization of the types of accounts into various categories here, which has also to be understood. So we'll be covering that in our session in the evening, which will start at 9 p.m. Please join us at 9 p.m. for the next session, which will be part 3 of journal entries. With that, we come to the end of part 2 of journal entries.